the economy is heading off a cliff, and as it does that, you've got credit card debt exploding, you've got personal savings drawing down to the lowest level since 2020, and then you've also got defaults rising. You've got the M2 money supply, which may have just peaked, showing deposits are being drawn down. So all of this does not spell good news for the Canadian economy. Credit card debt grows as Canadians struggle with spiking cost of living bills they just can't pay. And we've been through many times on this channel what is going on with real wage growth. I mean, if you haven't explored that, I'll link a video at the end on the end screens. But it's really interesting to take a look at it. A growing number of Canadians are missing monthly payments on non-mortgage bills as consumers slip further into debt amid high interest rates and a rising cost of living, according to a report from Equifax released on Tuesday. So more defaults, more people missing payments. This is not a good sign. And we know that growth of the economy is slowing way down. It's decelerating fast, and it will likely continue. The trend is very strong that will likely continue. We have to respect the trends here. And that means that we will go into a recession. Now, if you adjusted those GDP numbers for a more realistic CPI, we'd already be in a recession right now, which is kind of obvious to those of us here on the channel, but not so obvious to those who listen to the mainstream media. So the Credit Monitoring Agency said in its latest consumer credit report that 175,000 more consumers missed payments on at least one non-mortgage product, such as credit cards and vehicle loans, in the first quarter of the year, a 19% increase from the first quarter of 2022. And you know, you've got to think, we're talking about Q1 here, guys. We're talking way in the past right now. You know, it's just kind of insane. We're about to head into Q3 and we're talking about Q1. I mean, the data that we have here in Canada is just ridiculous. I wish we had more data, but we don't. We rely on, you know, places like Equifax to kind of just spoon feed us information, which we get on an extremely laggy time scale, and this is one of them. So, you know, this was in Q1. Remember that. It's worth bearing in mind. So 175,000 more people. And what does that mean for all the people with mortgages who've seen their mortgage payments increase massively? So meanwhile, Equifax said in its Tuesday's report, which I'll have to take a look at, that credit card debt continues to rise. On average, consumers are spending 21.5% more each month on their credit cards compared with pre-pandemic levels, the agency reported. So look, this is essentially what's happened. It's very simple, and we're going to go over it right now. So number one is the credit card debt. So consumers are screwed. They're spending more on credit cards. This would go for the majority of people. And then the second thing that's happening is those that have savings left over from essentially when people were able to defer mortgage payments and all this crap that happened during the pandemic, the stimulus. I mean, the stimulus is still going on in a lot of provinces like Alberta. People don't even realize, but stimulus still going on. And essentially, you look at the household saving rate, it's gone down. It's gone back to, you know, average levels. If you look at a 10-year chart, you can see how it's headed back down here to average levels right now. And what's really interesting about that is when you look at that, it's now fell. So the mainstream media and this argument that's been given for a long time, oh, we've got all this savings. It's this glut of savings why the consumer is so resilient. But it's obvious to me and you that it's not, because you just have to look at credit card debt, up 21% plus since before the pandemic. So, you know, people aren't able to afford the cost of living increases that they're experiencing right now. They're using fumes to pay for that. It's not going to end well, is it? It's really not going to end well. I mean, I think it's obvious to you and I, but to the average Joe, it's not obvious to them. They think the economy's booming. You know, this GDP report that came out, oh my gosh, like it's just a booming economy. The Bank of Canada needs to hike even more. And to me and you, we're just sat there going, you know, we know this is going to be an economic catastrophe that we're going to see. So the household saving rate is one thing. if you look at consumer credit, I thought this was really interesting because it's starting to show that it's peaked. But again, the data is lagging. We're looking at March data as the most recent data. But you can see consumer credit, it looks like it's peaked. But look how much this has gone up. So you had consumer credit go down, which was actually a good thing, which was because obviously of stimulus programs. It wasn't a natural thing that happened. It was because of the stimulus programs. People were able to defer payments and then pay down debt. So it wasn't anything actually natural that happened, like I don't know what happened there. It just kind of flicked off on the video. Sorry about that. So, that's what's happened on the consumer credit supply side. And then if we go over to the M2 money supply, that's really interesting because when you look at the M2 money supply, it's actually peaked. And when you look at the US M2 money supply, that is actually heading down, which is the first time since the Great Depression that has happened. So that is a major, major thing that you want to take a look at because that is measuring credit and it's also measuring total deposits. So if credit is being destroyed or people are drawing down deposits to a larger extent at the financial institutions, then you're going to see that show up in M2. So it's interesting, and it's not the first time. I must point out that it has declined because you look at July 2022, the same thing happened. So this could in fact just be something that, it's going to draw down and then continue back upwards. But I wouldn't be surprised if this headed down, especially considering what's happening with M2 in the United States. So M2 is the money supply. Like I said, it's credit. It's also total deposits essentially held at financial institutions. So it's showing you how much the money supply is growing to an extent. But it really shouldn't be called the money supply anymore. It should be called the credit supply. If the government massively increases their spending, then you're going to see large fluctuations in the money supply, obviously. And that's exactly what happened in 2022. I mean, if I show you this, a lot of people say this is inflation. But actually, that's not really technically true because most of what you're seeing here on this chart, this growth since 2020, which is an insane amount of growth, nobody can deny that, but it's mostly a growth of credit. And obviously, we know that their ability to actually service this credit, to actually pay back this credit, they're not going to be able to do that. So M2 money supply is an interesting thing. It's just one tool. I hate saying that word because central banks, politicians always say that word, but it's one tool that we can use to look at how much credit is growing, to look at what's really happening on the financial side at the financial institutions. But really, what's more interesting to me and what I find most interesting is what's happening with the household saving rate here, which is it's back to a normal level. And if you look and go back to the 1970s, for instance, look how much higher the household saving rate was. Why do you think that was? It's because even though interest rates were higher back then, people's incomes were higher. In the 1970s, you actually saw real wage income growth. Here, we didn't see that. We saw the total opposite of that because the CPI basket is so manipulated. It's a CP lie. And another thing that's incredibly interesting, because this typically happens and typically is the canary in the coal mine, is the credit card debt. That is typically the canary in the coal mine. That tells us before the recession happens that the consumer is in a bad place because credit card interest rates, they're at all-time high right now. So people who are putting stuff on credit cards, they're extremely desperate, and we have to remember that. So it's really interesting, guys, what's going on. I hope this was kind of useful to show you some different things and what I think is going on with the consumer and what is being backed up by this recent report from Equifax as well, which I'll dig into in more detail and then consider maybe doing a video on it. So if you've enjoyed this video, you might like that video there. You might also like that video there, another video from here in Casco Viejo in Panama City. And I will see you in the next one. Take care of yourselves, guys.